Tell me if this sounds familiar. You have a signal to trade. You enter. You place your stop loss in your take profit. And then price goes in the opposite direction. And then you pray for the chance to close your trade at break even. You hope that price will return to your entry point just to close that bad trade. This is you trapped in a losing position, and your entry point is your salvation. That's the psychology of a trapped trader. In today's video, I'll show you how to take advantage of trapped traders, and I'll show you how to identify key areas on the chart where traders are anxious and eager to exit their losing trades. So, like, subscribe, and stick around for the full video. When you place a trade, you expect the market to move in the direction you anticipate. If the market begins moving in the opposite direction, your fear takes over. You will continue to hold the losing trade, but hoping the market could still come back to your entry point. On some occasions, the market will end coming back to where you entered, and you will be able to close your trade at a small loss, or even better, at break-even. Unfortunately, the vast majority of time, the market doesn't come back, and instead continues to move further and further away from the entry point. True story, that's exactly how I blew my first account. I waited and waited for the market to return to my entry level, and at some point, the loss became so large, and I received a margin call. A trader trapped in a losing position is forced to take an emotional trading decision. Your goal is to identify and trade against the positions of such traders. You capitalize on the vulnerable traders who are caught on the wrong side of the market. So let's see where you can find traders holding losing positions in the market. There is one event in which you can be sure retail traders will place trades. This event is when the market makes a large move in one direction, a large range candle. These candles always make traders place trades. When you see a large range candle form in the market, a big number of traders will place trades in the direction of the candle. If the market begins to move in the opposite direction to which the large candle has formed, then all of the traders who have placed trades will become trapped in losing positions. How do you take advantage of this situation? Well, you know that their biggest desire is for price to return to their entry level. In this example, after this big green candle, lots of traders were trapped around this area. If the market continues to move against these traders, at some point, some of them will close their positions, but a lot of them will wait for a break-even chance. And look what happened when price returned to the previous level. You see the immediate reaction. Price rejected the level aggressively. That's because the losing traders finally had their chance to exit their trades. You want to find those areas on the chart and open a position when losing traders are closing their trades. In many cases, large range candles often turn into a different type of candle before they close. The candle they turn into is a pin bar. When pin bars are forming, they will look heavily bullish or bearish, depending on the type of the pin. But when big players come in, the candle which initially looked really bullish or really bearish now has a large wick on it. The wick contains the traders who are now trapped in losing trades. The longer the wick or the shadow of the bar, the better, because it indicates the wrong movement which has prevailed in the market. Look at this example. There are many wicks, but this one stands out the most. This would be the main wick I would try to trade. This would be the point of pain, the point where losing traders would happily exit their trades. Notice how price challenged the area of the pin bar, and look what happened. We have a first small rejection, and another one, this time much bigger. A long trade here would have been a decent trade. You enter a buy position where other traders close their previous sell positions. This adds momentum to your trade. A false breakout is when price moves beyond a previously established level and then retreats back below it. And of course, after a false breakout, many traders will be trapped on the wrong side of the market. If we look at this example from a typical retail trader's perspective, you can understand why such a large amount of traders became trapped in losing positions. To begin with, the market was advancing higher, which made many traders believe the market was in a strong uptrend. As the price climbed higher, a bullish range candle started to form, which made the retail traders think they were seeing a significant upmove taking place. As a huge mass of retail traders started to buy, smart money saw an opportunity to take profits of their own buy trades, using the buy orders from the retail traders. That resulted into a false breakout, and the retail traders are now stuck in losing long positions. And look what happened the next time price reached the previous level. An immediate reaction. Losing traders had their chance of exiting their trades, which drove the market down. Again, you want to target this area for a short entry. A breakout of an important level with a large body candle without a retest is another situation during which a lot of traders are trapped. Let's analyze this chart. Price fell aggressively right through the support level. The breakout candle was a big red candlestick. No chance of retest whatsoever. As price continues to drop, buyers are trapped. They wait for price to climb back up to exit their trades in the hope of limiting their losses. The short traders are now happy and may consider adding to their positions if the price revisits the price level. Lastly, the traders who didn't enter the market may go short if the price comes back to the previous support level, in anticipation of prices dropping further. And of course, look at the reaction at the level. Human emotions play a big part in the price action observed in markets. A price chart can be seen as a timeline of optimism and pessimism. It illustrates how market participants react to changing future expectations. When you see a range or consolidation in a chart, while there is average to high volume, the market is in the process of accumulating enough trapped traders before it can shake out that area and make another move. In this example, we see an accumulation zone. We see price breaking below support before moving in the opposite direction. This is called a spring in Wyckoff's terms, a pattern which traps any bearish breakout traders in a losing trade. It also traps the bulls out of their long trades if they have their stop loss below the consolidation. Often, you'll see patterns of an upthrust, which is a breakout of the distribution pattern at the top of an uptrend, which then reverses and heads down. In this example, here's the distribution zone. An upthrust is simply a false breakout of the consolidation area. This green candle, where weaker hands expect a breakout. The market breaks out of the consolidation only to return within the range. The following candles trap long traders in a losing position. Now, during accumulation and distribution phases, we can't use the same strategy as before to take advantage of trapped traders. We can't wait for price to return at the previous spring level to enter. It would be too late. Generally speaking, the accumulation phase forms as institutional traders increase their buying and drive demand. After the spring, as more interest develops, the trading range displays higher lows as prices position themselves to move higher. You want to be in the market at the beginning of a markup phase. With buyers gaining power, prices push through the upper level of the trading range. At this markup phase, the market will show a consistent upward trend. When a gap occurs, usually on the stock market, you can bet a lot of traders remain trapped in their positions. You could say the price jumped a certain distance, meaning it closed at one price and then opened higher or lower without touching the intervening levels. There's a saying among market participants that all gaps need to be filled. A gap getting filled is when price action at a later time retraces to the last closing price preceding the gap. Once it's retraced fully, then the gap is considered filled. Gaps usually form as a result of low liquidity as the market closes and then reopens the next day. When gaps form overnight, it's a sign that the market sentiment has shifted. Market participants are no longer willing to pay the same price on the open of the next day as they were on the previous close. Many times, at least when it comes to the bigger gaps, it's a sign that new information has been released and taken into account by market participants. When we have a gap, lots of traders are trapped in losing positions. And when the gap is filled, and price reaches the point of pain of many losing traders, you will often see an immediate reaction. That's one of my favorite setups. A gap which is filled, combined maybe with another level of confluence, makes for a decent trade to take advantage of losing traders. Markets move in waves, with impulsive and corrective moves. A very popular trading method is trading the corrective move and entering a trade in the direction of the trend once the corrective move signals completion. The issue is that many traders are impatient and don't want to risk not being in the move, so they enter trades too early at the first sign of completion. But what may appear to be a simple pullback will actually be a complex pullback on a lower time frame. The first wave indicates the first leg of this pullback, and the pin bar looks like it could indicate a resumption of the uptrend. Traders enter and place their stop below the candle. Price then turns around and makes a second wave and traps long traders. Being on the right side of those moves can move your positions into profit very quickly. Again, the key is to see where traders may be on the wrong side of the market and get yourself positioned to take advantage of them when they have to exit their losing trades. you found value and learned something new, leave us a like. This way we'll know if you'd like to see more videos like this one. And check out our Academy program if you want to further level up your trading. Until next time.